Okay, picture this. It's Friday, March 17th, 2023. The world's financial markets are officially winding down for the weekend. But inside the absolute highest levels of the Swiss government, it is a scene of total, unmitigated panic. We're talking the government, the central bank, and top financial regulators who have essentially locked themselves in a room. And what they are staring at is a mathematical reality that threatens to trigger an absolute global financial meltdown the second markets open on Monday morning. One of the largest, most systemically important financial institutions on the planet is in a complete death spiral, and it is entirely out of cash. They need a rescue plan, and they need it in the next 48 hours, or the shock waves are going to tear through the entire global economy. So, welcome to this explainer. Today, we are unpacking the biggest, wildest banking collapse since 2008. The numbers these regulators were looking at that weekend were just staggering. Customers were pulling their money out of the bank at an astonishing, frankly terrifying speed. We're talking about billions of dollars literally vanishing from the vaults every single day. By that Friday, the bank was hemorrhaging $10 billion in daily outflows. $10 billion! But the absolute mystery here is how, right? How does a 167-year-old titan, literally a global symbol of Swiss financial reliability, suddenly find itself on the brink of complete annihilation? What on earth happened behind those closed doors to drive the world's wealthiest clients to just pack up and flee? Well, to truly understand the climax, we have to keep the events of that fateful weekend a secret for just a moment and look at the clues hidden right in the data.
Okay, let's dive into this. If you look right here, you'll see this wasn't just some overnight flash crash. No way. It's a slow, agonizing grind downward, mapping right alongside a frankly unbelievable timeline of scandals. You can actually see this catastrophic decline over the years, punctuated by all these crazy events like a surveillance affair, the Archegos default, and wild social media news. To understand why this chart basically looks like a staircase leading straight into the abyss, we have to flash back to a time when Credit Suisse was actually sitting on top of the world.
Let's rewind for a second to the period right after the 2008 global financial crisis. While banks all around the world were completely collapsing or begging for taxpayer bailouts, Credit Suisse survived relatively unscathed. In fact, they were actually named the best bank globally. But, survival bred arrogance. Former executives later admitted that because they were almost completely unaffected by the 2008 crisis, management fundamentally believed the bank didn't really need to change anything. They grew incredibly complacent. The chairman from 2011 to 2021 oversaw a period where the stock declined by 75%, yet a handful of top executives were still being handed hundreds of millions of francs in these super opaque profit-sharing deals. They literally thought they were invincible. But without even realizing it, they were setting the perfect stage for a tragic, slow-motion downfall.
Because what actually killed Credit Suisse wasn't just some bad math or a single terrible trade. It was a phenomenon known in the industry as a reputation spiral. You see, in banking, trust is pretty much the only currency that actually matters. If people don't trust a bank, they pull their money out. Simple as that. A reputation spiral is the compounding weight of all these disconnected, bizarre, and entirely avoidable scandals that slowly, day by day, erode client confidence over years. The bank's internal culture just became completely toxic, constantly prioritizing short-term profits and totally turning a blind eye to massive risks. And wow, wait until you see exactly what that culture produced.
The tension in the financial world really started to build as Credit Suisse unleashed this relentless, non-stop drumbeat of corporate failures. Honestly, it was like watching a thriller where the protagonist purposefully makes every wrong decision possible. In 2020, we had Spygate. Then, in March 2021, the massive Greensill Capital collapse, which was followed just 3 weeks later by the Archegos default. And then, October 2021, the Mozambique Tuna Bonds fine. Guys, any single one of these events would be a massive, generational crisis for a normal bank, but for Credit Suisse, it was literally just another Tuesday.
Let's actually detail a few of these because they are truly wild. In 2020, Credit Suisse's CEO was actually ousted after it came out that the bank hired private detectives to spy on their own former wealth management chief, Iqbal Khan. It even escalated into a physical confrontation with him right in downtown Zurich. You can't make this stuff up. Then, a Swiss court convicted the bank of failing to prevent a Bulgarian cocaine trafficking ring from laundering 146 million francs straight through their accounts. And right after that came Swiss Secrets, which was this massive data leak of 18,000 accounts holding over $100 billion. The leak revealed funds tied to human rights abusers, drug lords, and heavily sanctioned businessmen. With every single new headline, whatever public trust they had left just completely disintegrated. But look, these scandals weren't just embarrassing public relations nightmares. They had devastating real-world consequences. Take the Mozambique Tuna Bonds scandal, for example. Credit Suisse arranged $1.3 billion in secret loans, which were supposedly going to finance coast guards and tuna fishing in Mozambique. But instead, a massive chunk of that money was completely diverted for bribes. Because these loans were deliberately hidden from the International Monetary Fund, the IMF ended up pulling its support, plunging Mozambique's entire economy into a brutal crisis. The human cost here? Over 2 million people were pushed straight into poverty. To put that into perspective, this single deal cost the country the equivalent of its entire 2016 GDP, and it ended up costing the bank a $475 million fine from regulators.
And then came the absolutely brutal financial hits of March 2021, proving once and for all that the bank's voracious appetite for risk had finally caught up to them. First up was Greensill Capital, a British financial firm with a super opaque lending model. When it collapsed, it forced Credit Suisse to instantly freeze $10 billion in connected client funds. Just 3 weeks later, a U.S. family office named Archegos Capital Management totally defaulted. Archegos' highly leveraged bets spectacularly blew up, and Credit Suisse was the one left holding the bag, suffering a staggering $5.5 billion loss. An independent review later came out and explicitly called this a fundamental failure of management and controls.
So, what exactly is a total return swap? Let's break down the mechanics of this Archegos disaster for a second, because if you're following this, you really need to understand exactly how one single client blows a $5.5 billion hole in a massive bank. The manager of Archegos, Bill Huang, used these financial derivatives called total return swaps. Essentially, banks, including Credit Suisse, bought and held the actual stocks on Huang's behalf and just paid him the returns. This clever little loophole allowed Huang to borrow massive amounts of money, leveraged at roughly 5-to-1, all while completely circumventing regulatory disclosure requirements. To the investing public, he was completely invisible. But when the underlying stock suddenly crashed, Huang couldn't meet his margin calls. Other major banks saw the writing on the wall and liquidated their positions immediately. But Credit Suisse, they hesitated, hoping the market would somehow magically stabilize, and that hesitation cost them billions.
And this brilliantly illustrates the absolutely terrifying new threat landscape in modern banking. Historically, a bank run meant literally standing in a physical line outside a brick-and-mortar branch to withdraw your paper cash. It took time, it was a slow burn. Today, we have what's called the digital bank sprint. Depositors can withdraw billions of dollars in seconds just by tapping a smartphone app. There are no physical lines to slow things down. And when you combine the frictionless speed of modern technology with the viral, explosive panic of social media, a wounded bank can completely bleed out in a matter of days, not months.
And Credit Suisse felt the full, unforgiving force of this in October 2022. It all started with a single, completely vague tweet from a journalist suggesting that a major international investment bank was on the brink. The tweet didn't even name Credit Suisse, but Reddit's Wall Street Bets community and jittery global investors instantly connected the dots. The rumor went completely viral, and even though that original tweet was quickly deleted, the damage was completely irreversible. Panicked clients pulled out $67.4 billion in just over a month. By the end of the fourth quarter of 2022, a jaw-dropping 138 billion Swiss francs had fled the bank. The digital sprint was fully underway, and it was brutal. Just take a look at the stark contrast we have right here. While the light blue line representing their net profit just plummets off a cliff, do you see that drastic, terrifying plunge way below the zero line for retained earnings in 2021 and 2022? After years and years of paying out massive dividends and buying back their own shares, the mountain of regulatory fines and catastrophic trading disasters completely hollowed out the bank's financials. They reported a staggering net loss of 7.3 billion francs in 2022 alone. They were fundamentally weak, bleeding cash by the second, and utterly, desperately dependent on the fragile trust of whatever depositors they had left.
Which brings us right to the terminal nosedive of March 2023. This is where the dominoes really start falling, and fast. On March 8th, the US SEC steps in and forces Credit Suisse to delay its annual report over cash flow questions. Red flag number 1. On March 14th, the bank finally publishes it, openly admitting to material weaknesses in their financial controls. And this drops right at the exact moment Silicon Valley Bank spectacularly collapses over in the US, making global investors hyper-paranoid. The entire market is looking at Credit Suisse and seeing a deeply wounded animal. And then the ultimate fatal blow is struck, live on television. So on March 15th, a Bloomberg TV anchor is interviewing the chairman of the Saudi National Bank, who happens to be Credit Suisse's absolute largest shareholder. The anchor casually asks him if they would be open to injecting a bit more capital just to help stabilize the bank. His response was just 2 words: absolutely not. Bam. Those 2 words acted as the ultimate catalyst. Credit Suisse's shares immediately plummeted 24%. Credit default swap spreads, which is basically the cost to insure against the bank going completely bust, skyrocketed past 10%. Outflows accelerated to a mind-numbing $10 billion every single day. Even when the Swiss central bank threw them a massive 50 billion franc emergency lifeline the very next day, it did absolutely nothing to stop the panic. The trust was entirely, permanently gone.
Section 1. The Shotgun Wedding. Switzerland's Desperate Sunday Rescue.
And that, my friends, brings us right back to that locked room on Friday, March 17th. The Swiss government knew deep down that Credit Suisse was not going to survive the weekend. If it defaulted on Monday morning, it would take the entire Swiss economy and potentially the entire global financial system down into the abyss with it. So they arranged what financial analysts are calling a shotgun wedding, quite literally forcing their biggest rival, UBS, to buy the failing bank. Now, UBS did not want to do this. Buying a failing, highly complex bank in the middle of a global panic is essentially like buying a giant mansion while it's actively burning to the ground. The government had to offer massive, unprecedented sweeteners and guarantees just to force this deal through before the Asian markets opened on Sunday night. When the smoke finally cleared late Sunday, UBS had agreed to swallow Credit Suisse whole for just 3 billion Swiss francs, which is about 3.2 billion US dollars. That is shockingly low. It was absolute pennies on the dollar compared to what this 167-year-old institution used to be worth. The shareholders got roughly 76 Swiss cents per share. That's 59% less than their value just a few days prior. But you know what? The true shock of this deal wasn't actually the ridiculously low purchase price. It was the totally unprecedented, arguably ruthless way the Swiss regulators decided to ram it right through the legal system.
Because to make this mega deal happen before Monday morning, the Swiss government invoked extreme emergency constitutional powers to completely bypass a shareholder vote. They literally stripped the owners of their legal right to approve or deny the sale of their own company. And the international backlash was immediate, and it was fierce. Massive investors over in the Middle East, huge proxy advisors, they all expressed absolute disbelief, stating that changing the law over a single weekend was a blatant expropriation of shareholder rights. As one analyst starkly put it, many felt Switzerland's pristine reputation as a reliable, rule-of-law financial center was entirely shattered, even likening it to a financial banana republic.
Section 2. The Climax. The move that shook the financial world.
But as crazy as it sounds, bypassing the shareholder vote was really only the appetizer here. Because what happened next was an unprecedented regulatory move that shocked global investors even more than the bank's actual collapse, spawning billions and billions of dollars in furious litigation. To understand this true climax, we need to quickly look at something called Additional Tier 1 or AT1 bonds. Think of these basically as the airbags of the entire banking system, which were introduced right after the 2008 crisis. Investors buy these bonds because, hey, they pay a really high interest rate. But the catch is, if the bank runs into severe trouble and its capital falls below a certain level, these bonds can legally be converted into equity or written down to absorb the losses, which protects the everyday taxpayers from having to foot the bill. So by definition, they are inherently risky.
So during that incredibly tense Sunday night press conference, the Swiss financial regulator FINMA steps up to the microphone and delivers a staggering plot twist announcement. As part of the UBS takeover, they announced that all of Credit Suisse's AT1 bonds were going to be written down to zero. That is $17 billion of investor money held by massive pension funds, mutual funds, and individual investors all over the globe, instantly, permanently vaporized. Poof, gone. The airbag had deployed, but with explosive, devastating force.
Now, you might be wondering, why did this cause such absolute global outrage? Well, it's because it seemingly violated the absolute golden rule of finance. Traditionally, the capital structure hierarchy is deeply sacred. If a company goes bankrupt, the shareholders, meaning the owners, they are supposed to lose everything first. They drown first. Bondholders, the lenders, are supposed to be strictly protected until the very, very end. But this Swiss bailout flipped that entirely upside down. The shareholders actually walked away with over $3 billion from UBS, while the AT1 bondholders were completely wiped out to zero. How on earth did they get away with this? Well, the answer was buried deep in the excruciatingly boring fine print of the Swiss bond contracts, which actually allowed a write-down in a viability event involving government support, totally regardless of what the shareholders received. So yes, it was entirely legal under Swiss rules, but to the rest of the world, it completely broke the unwritten laws of global capitalism.
So what does this all mean for the aftermath? Well, global bond investors obviously screamed foul play immediately, and it has already spawned $9 billion in ongoing legal claims against the Swiss government. We watched a 167-year-old titan get entirely undone by a digital bank sprint and its own toxic culture of endless, totally avoidable scandals, only to be forced into a frantic weekend rescue that quite literally rewrote the rules of finance. So I want to leave you with this provocative thought to consider. Was vaporizing $17 billion of investor money a necessary, brilliantly executed maneuver to save the global economy from a catastrophic Monday morning meltdown, or was it the exact day the golden rule of capitalism was permanently broken, forever shattering our trust in the system? Think about that for a bit, and we'll see you in the next explainer.